Hi, welcome to the Market Alert for Monday, the 21st of December 2015. So Friday, fairly quiet in the pre-markets, about 100-point range, if that, just from there to there, about 100 points. And then the market started to move slightly higher. You can see definitely got a 100-point move there. And then the early morning rally soon fizzled out as the markets then took on some very wide-ranging price bars and the market moved lower. So you can see in the first half the volatility was very extensive with bars. Here's a 50-point bar there, another 50-point range bar there. Again, even later on in the first part of the session, another 50-point bar there. And then eventually the market settled down, having moved 200 points lower. And then in the evening part of the session, we had a buy signal, which was part of the dead cat bounce. As they are known, the market will move higher and then fail and move back in the direction that it was originally trading. Dead cats bounce, but they don't run off. And there's a perfect example of this. You can see there the cat bounces as it hits the deck, but it doesn't actually run off back to the upside. Metaphorically speaking, of course, with the market, and then eventually you see the market run out of steam and then head back to the downside there. So in the daily chart, you've got the market hitting the support 17,125. Spoke about this in Friday's market alert. It's going to be an interesting level now to see how the market copes with this when it opens late on Sunday night through to Monday. But of course, this week we're heading into Christmas week, and we've got no news tomorrow, so you'd be warned that there is no news tomorrow. And then things don't really improve on Tuesday. We just got the final GDP from the US at 130 in existing home sales. Wednesday, there's a whole stack of news out before we get to Christmas Eve on Thursday. Again, most of it the US, so it'll be interesting to see how the market reacts on Wednesday. But certainly tomorrow, who knows what will happen, or today if you're watching this on Monday, what the market's likely to do. Anyway, you'll determine that is by seeing what the overnight market's done. But I suspect that it's still going to be fairly quiet as well, and I wouldn't be surprised if we don't see a bit of a bounce this week as the market gets in towards the Christmas Eve and Christmas Day celebrations. Now next week the market opens as usual for the US, slightly different for the UK, bank holiday Monday because Boxing Day is on the Saturday. But the US back to normal on the Monday, and I'll continue to record through the Christmas period as well, as sometimes we can get some really good moves during this time when everybody else is away from the market, and given the fact that interest rates have just risen in the US, wouldn't be a bad idea just to keep an eye on things as well. And finally, in the implied volatility, 1707, and again, no surprise really after the market dropped 200 points on Friday's trading session. Apologies there, it's recording on a Sunday. So yeah, Friday implied volatility up slightly as the market moved lower in the underlying market there. So that's it really for today, short and sweet and to the point. I had one or two questions with regards to changing the trading range of the bars, so I'll just go back to this for you and to the 5-minute chart. You're more than welcome to change the range. At the moment I keep in mind at 25, but if you wanted to change this to 50 so that you can pick up some of these bigger moves, then there's no problem in actually doing that. What you've got to make sure is that you still maintain the same risk percentage so that when you actually have the trades mark up, and I'll just show you this, you can see that there, you can see the 74 points in the actual stop there, in the initial stop that is, and it seems slightly inverse to the move, but of course you've got more volatility so the market can move further. As you see here, the market moving down sharply to around, again giving probably not too dissimilar in the actual risk there. If I just grab that, move that down to there, 63 points. But you've got to let the market breathe with the increase in volatility. So the only way to compensate for this is to make sure you still don't breach the 1 to 2% of initial risk. So it's not the size of the stop that's important, it's how you actually manage the risk as with regards to how much you're going to or how are actually prepared to risk initially. So I tend to keep mine down to 1.5%, 2%, and that way it allows me to have bigger stops, you just reduce the bet per point in order to compensate for it. So you're free to change this as and when you want. But again, like I say, the most important thing is to actually manage the risk there and work out the bet per point that you will be exposing yourself to. Right, that's it. I will see you in Tuesday's edition, unless there's anything catastrophic or geopolitical nature that comes to light. Then if it does, I will let you know via email. Other than that, let's hope there's enough volatility to move things through for the first 3 days of this week. Thursday, of course, Christmas Eve, half-day trading, and everywhere short on Friday. Right, that's it. See you in the next one. Thanks for watching.